It's an absolute pleasure to be here with you all this morning. Thank you for coming. I would reiterate pretty much everything that Andrew said, although I did my undergraduate degree at Cambridge rather than Oxford, and I don't quite remember it being quite the same as his experience at Oxford. I remember really enjoying economics and definitely I worked quite hard at it. And that was really a product of the teacher I had at high school who introduced me to economics. So, someone like you guys, she really inspired me. She helped me get in the first place and set me on the journey. And before I got to the age of 15, 16, I hadn't even really heard of the subject. So I just would really like to reiterate how important the work you do is. It's absolutely vital. Everything Andrew said, I would reiterate. So I'm here. I'm the chief economist and the assistant governor economic for the Reserve Bank. So I have a team of around about 120, mostly economists. We also have some data scientists and some other staff that help us out with the work that we do. We're collectively responsible for advising the board on what's happening in the economy, and then working across the bank with what that means, we think, in terms of monetary policy setting. So what should they do with the cash rate is what we spend an awful lot of our time thinking about. So the team have asked me to give you guys a bit of an update on how we're seeing the economy at the moment and what that's looking like in terms of the policy settings. So what can I tell you about how we've been seeing things over the last 6 months or so through 2024 to today? Well, a general observation, this actually goes back a bit pre-2024, is that the world's done pretty well in the face of rate hikes. So the pace of tightening that we've seen, so the increase in interest rates that central banks around the world have put through, really quite rapid. If you look at it on a chart, it looks like we've gone up an elevator as opposed to going up the stairs. And actually, world economy's done all right against that. Growth rates are a bit slower than they were pre-COVID, certainly slower than they were through the immediate recovery from COVID, although I think that's kind of understandable if you put a whole bunch of people, tell them to stay home for a while, and then you let them all go out and they go shopping and eating out and on holiday and things, you do get a pretty rapid bounce back. That aside, actually the world economy's done okay. So we've had recessions in some of the slower growing countries, the UK, for example, places like Japan, but the bigger, slightly more dynamic countries like the US, they haven't had a recession. That's a surprise. 18 months ago, many people in the economics profession were saying it's definitely going to happen, and we've yet to see it. So you can take that, I guess, as a really quite a major success for policy that we've been, and I'll show you the inflation numbers in just a second, but the fact that we've been able to bring inflation back down from some very high rates that we wouldn't want to sustain, to not quite done the job yet, but we're getting a bit closer, and that we've been able to keep economies going. We've not had to see substantial job losses. I'm sure many people in the room might remember the early 90s recession. I remember there was about the same time there was a recession in the UK. It was devastating. For me personally, my dad's business nearly went under and my parents got divorced. So I really know what a recession feels like to an individual. It's a devastating experience if you're unlucky. The fact that we've been able to largely avoid that, maintain most of the job gains, most of the falls in the unemployment rate, which is what you can see on the chart right now, is, perhaps we should take that as a real positive of policy. But, and this is where we show you the inflation numbers, we're not there yet with inflation. We do still have inflation above central bank targets. You might broaden that description to say above low and stable rates. So most central banks globally target an inflation rate around 2%. We have, middle of our target around here is 2.5%, so we're not too dissimilar to everyone else. And as you can see on the chart here, we do still have inflation above those rates, right? Somewhere between 3 and 4% is where most developed countries are sitting. I'll come back to Australia later. We're sort of towards the top end of that. So still some work to do. The other interesting observation that we've had over the last 6 months in particular is that financial markets and economists, generally speaking, are now thinking that interest rates are going to have to stay higher for longer. So yes, we've been able to achieve those labour market outcomes. We've not had big increases in the unemployment rate in most countries, but we've still got inflation above target. It's been more persistent than we expected. So particularly services, it's just sort of got a bit stuck on that sort of slowing down trajectory. And so now we, generally speaking, the profession thinks and markets think that interest rates have got to stay higher for longer. And you can see that on the charts. The grey lines are where financial markets thought interest rates were going to be about 6 months ago. And the coloured lines are for each country are where they now think interest rates are going to be today. So you can see that all the lines are higher to at least some extent. So that's interesting. Why is that? Have we, as a profession, economists, misjudged the pace that inflation can come back down? It's going to take a bit longer. We have to keep rates a little bit, a bit higher to get it there, to rebalance our economies. Is it because rates are structurally higher relative to the pre-COVID years? If you can see on this chart that pre-COVID is pre-COVID isn't shown here, but if I rolled the chart back a few years, most of these countries would have an interest rate that's closer to the 2021 level than the current levels. Interest rates were definitely lower before, and that's true in Australia. Maybe they shifted structurally higher. That's an interesting question. Why? Maybe we can come back to that in the discussion. It's a really important one, right? If we think that neutral rates are higher now, then that sort of changes the policy advice that me and my team will give the board. Investigating that is one of our active areas. So I sort of point this out to say that, as Andrew said, we don't know everything. We're constantly learning. One of the big messages I always give to my team and I have for myself is being humble and curious. I love to learn. I'll be talking about interest rates on my deathbed, I think. It just fascinates me. I love economics and I love the fact that we don't know it all. It's gloriously grey and we get to play in the grey. I think it's a real privilege. I'm really lucky in my job to do that. So that's one of the puzzles that we've got. Moving on then, what's happening close to home, at home, as it were? Well, it's a bit of a mixed picture across the economy here. It's been a really interesting time to track it. This chart I like because it sort of shows you how bad COVID was. It actually doesn't show you how bad COVID was. We chopped the chart because otherwise it looks really stretched and you can't really see what's going on quarter to quarter now. But suffice it to say, those 2020 negative bars went really negative. That's what you do if you tell 15% of your workforce to stay home because we're going to shut their businesses down, and everyone else keeps the lights on, as it were. So we had this really big downturn. Then we let people out again, and you get a really big upturn. You can see the second little spike in 2022. That's the rebound from the Delta lockdown. So the joy that we had here in New South Wales and in Victoria and ACT. But obviously, if you've travelled over from WA or Queensland or other parts of the country, you guys weren't in lockdown then. So that's why it's a smaller spike, only half the country locked away. And then since then, the recovery sort of eased a bit. Well, that's natural. We can't just keep rebounding. But what you can see on this chart, I think is really interesting, is that the purple bars, they're usually in normal times, if you look pre-COVID, they're normally the biggest. That's household spending. Accounts for, back then it was around 55% of the economy. Right now it's half of the economy. So it's the biggest single chunk. So it's normally the biggest contribution to growth. So that bar is smaller. The other two bars though, the yellow and the green, are bigger. The green is business investment. Generally from a broader policy perspective, that's pretty good news. If businesses are investing, they're expanding our productive capacity. Hopefully we're becoming more efficient if they're upgrading their IT systems or putting in the latest machinery and equipment. That should be good for productivity, we hope. So that's a positive sign to see, generally speaking, and it's larger than it has been. We've also got yellow bars that are a little bit bigger than they have been previously. So government spending, public demand, that's both current consumption, so spending on things like NDIS, health, education, that's what drops in there, plus investment. All those infrastructure projects. I don't know if anyone lives in Sydney and drives the bridge. I do every day. Goodness me. My husband told me recently it's going to be 2028 when they eventually finish. Oh, and then they'll probably start something else that's on my way to work. Yeah. So it's a never-ending cycle. Those yellow bars are a little bit bigger than they have been in the past as well. So that's what's helping to support the economy. So I'll talk a bit more about households now and the softness there, the weakness there. It's very tangible. It's a thing we can all grab hold of. And so it's getting a lot of attention. So why is household spending weak at the moment? Well, I can tell you that the single biggest problem that households are facing at the moment in terms of their real spending power is inflation. Wages growth has struggled to keep up with inflation recently, particularly since 2021 when inflation really took off. And that's weighing on everybody. Doesn't matter who you are. If you're going and doing your food shop today, you're probably paying about a quarter more than you were a couple of years ago. You can be the richest person in town. You can be at the other end of the spectrum. We're all facing that. So inflation is the problem for households because it's affecting everybody. Other households are being hampered as well and weighed down by higher interest rates. anyone in the room with a mortgage, I probably don't have to tell you that you're paying a bit more. And we get that. I personally have a mortgage as well, which I have to declare as part of my job. So I'm seeing it too. So we know that particular group are getting squeezed in both directions. So we've got the inflation and we have those higher interest rates. Thing with interest rates, though, is that not all households are actually directly negatively impacted by them. There is a group of households actually who typically don't have a mortgage. They are typically older. I mean, that's sort of a natural byproduct of, you paid your mortgage off, you're likely to be older than younger. They also quite often will have some form of financial asset, money at the bank, some other interest-bearing stuff. They're made better off when we raise interest rates. So households as a group overall have more debt than assets in that way, financial assets. So generally speaking, higher interest rates does weigh on total spending. And we're seeing that in the data. You can see how slow consumer spending has been just recently. But it's a very, very mixed experience and a mixed picture. And we're very aware of that. It's really tough. We know some people are doing it really tough. We do talk to organizations that help people out when they get into trouble and strife. The banks are telling us about the people who contact them and reach out to say they're really struggling and with their mortgage payments in particular. We know it's hard, but we also know that not all households are in that bucket. The other really interesting thing about household spending is there's a further channel through which interest rates are having an impact. So what I just talked to you about is what in economists in the bank, we refer to that as the cash flow channel. So literally your disposable income is made lower because interest rates have gone up, because you've got to pay more interest on your mortgage generally. There is also some evidence that some households, and these are wealthier households, richer households, higher levels of income, are actually choosing to save more. That kind of makes sense, right? If you're facing a higher interest rate on your mortgage and you've got an offset account, you probably want to throw as much as you possibly can into it because you're facing a higher interest rate than you were before. And no one wants to pay more interest than they have to, right? Equally, even if you don't have a mortgage or any other form of debt, if you can get more income from putting money in the bank, say, then for some people, they'll choose to do that. They'll choose to spend a bit less today, put the money in the bank, get the income, and they've got more income for tomorrow. What I'm describing there is the intertemporal substitution effect, right? That higher interest rates make it more attractive to save than to spend, generally speaking. And so we can see some evidence of some households doing that. We do think it's wealthier households, richer households, makes complete sense. Notwithstanding that inflation squeeze, they've probably got the disposable income to do that. So again, we do understand that the households at the bottom of the spectrum, it's just tough. High inflation for that group is really hard. They really struggle against it. It's from a welfare perspective, one of the reasons to get inflation out of the system, because that's the group that's most impacted by it in a negative sense. They have the smallest financial buffers. As soon as their pay doesn't start keeping up, they're really generally making some tough choices on the essentials. And so we want inflation out of the system. So that group, one of the reasons is so that group are not so badly impacted. So it's not that group that are choosing to save more by any stretch, but there are other richer households that we think might be. So household spending is getting crimped in a number of directions. So it's not a surprise that in the chart I just showed you a couple of slides ago, that purple bar is smaller than it usually is. The other channel where we can see interest rates having an impact is residential construction, so building a new home. That's very affected by what happens to interest rates, because you generally have to take on debt to build a home. You take a mortgage if you're building a new home, or if you're doing a big renovation project, putting on an extra story or converting your attic or what have you. It's not the only reason this sector's struggling, though. I probably don't have to tell you that it's pretty hard to find a tradie right now. And if you can find one, they're certainly charging you a fair amount more than they were pre-COVID. Some very big nods in the room. If you've tried to do a big reno recently, you will know this. Again, personal experience kicking in for me too. And that just plays to there being other challenges in this sector as well. So construction, building a new home in particular, is struggling with a lot of things around labour shortages, around high cost of materials. There's lots of construction activity going on. Again, you can just look out the window here and you can see a lot of activity. That's common across the country. So that sector is being squeezed by a number of different things, but part of that is interest rates. So that's where we've got softness. Where have we got strength? I mentioned business investment, which is very good to see from a productivity, sort of economic development, if you like, perspective. We've also, as I said at the start, got some strength coming through in government spending as well. So there was a sort of cycle through COVID, and obviously spending was very high during the pandemic. It's come down a little bit in terms of its share of the economy, but it's higher than it was pre-COVID. And there's a lot that the governments around the country are trying to achieve in terms of the clean energy transition, spending on the NDIS, things like this that come through in the numbers. And so we can see that very clearly. So what do we expect going forward then from here? Well, we think that growth is going to pick up modestly from where we are now. So we think that this is the worst period. For households in particular, we're getting a bit of support from things like the tax cuts. There's the energy rebates that are going to start to appear on, depends where you live in the country as to how you get them, but they're going to start to appear over the next little while as well. And we now have wages growth that's running stronger than inflation, just about. So that means that in real terms, as you get your pay rise this year, it should more than compensate for the increase in what you're having to spend. That's an average. That might not be true for everyone. In fact, it won't be true for everyone. But for the average person, that is the case. So we do think household spending will start to pick up a little bit in terms of its spending. Talked about those other supports, and you can see that coming together then with slightly stronger growth through the next couple of years. What does all that mean for the labour market then? I'm conscious of time too. I should probably get a bit of a wiggle on. Well, we're seeing in the labour market a sort of mirror of what I just talked about for the economy, for activity. So the labour market, we went through a period a couple of years ago now, in 2022, when demand for labour was just really, really strong. We have a liaison programme at the RBA where we talk to organisations across the economy in all different sectors. It's really helpful to hear from people, to get their views. What are they feeling on the ground? What are they seeing? What are we missing in our data? Because our data is not perfect and it gets revised. So I'd much rather hear it in real time if I can. And a really lovely story that we had that came out of our liaison programme from someone recently was, well, a couple of years ago, I was so short of people that if you walked in the door and wanted a job, as long as you had a pulse, I gave you the job. Yeah. I couldn't get anyone. So if you came to me wanting a job, you had a job. And I'd just find something for you to do because I had so much work to do. I just needed people. Now, it's a bit better. I'm not quite that desperate. They need to have 2 working arms. This is a guy in the construction sector. But we're not up to arms and legs yet. So you're still struggling a bit for workers. Yeah, that's right. So there was a lovely description of what's happening in the labour market, that it was tighter a while ago, a couple of years ago now, in 22 and early 23, it was at its tightest. It's easing off, but we're not back to pre-COVID yet. So this chart is what comes from our liaison programme. So as you can see, the red and the yellow lines together, that's if they want to expand their workforce or hold it steady. The red has come down, that's the expansion line, but it's still maybe about where it was pre-COVID and maybe a touch high. And the yellow is also a touch high. And the firms that are perhaps looking to sort of restructure and things, they're a touch low. So we're getting there, but we're not there yet. It's also what we see in the actual labour market data itself. And we got the data yesterday for June, as it happens. So the unemployment rate yesterday came in at 4.1%. That's well below where it was pre-COVID. That's not to say we think we have to go back to pre-COVID levels. We actually don't, but it's way down on pre-COVID, but it's a little bit up on its lowest point, which is around 3.5%, and we've now moved back up to sort of 4.1. So we've had some easing, but we don't think we're quite there yet. The other way we've had easing, and this is really important to us, we don't just look at formal labour market outcomes. We certainly don't just look at the unemployment rate. I know it might seem that way if you read the press, that's all we look at. It's not, I promise you. There are other ways that the labour market can ease. You can have businesses just look for fewer people. So the number of vacancies can go down, or the number of new job adverts starts to come down. We've seen that happening. In fact, we think that happens first before we start to get any movement in the number of people employed, in the unemployment rate and those types of indicators. So we've already seen that happen. We've also seen some easing coming through in hours worked. So for some businesses, they're not letting people go necessarily, but they're cutting down the number of hours that people work. If you've got a casual workforce, that's a relatively easy flex that you can do. Also means that you can, that's if you care about your workforce, you can sort of share some of the of that sort of reduction that you need to make. And we can also see it coming through in some of the sort of subcategories of the labour force. So, for example, we know that the unemployment rate for younger people, so sort of 15 to 24-year-olds, that's typically higher than for the rest of the workforce. That's not too surprising. In that group, you've got people who are just entering the labour force for the first time, typically. Might take them a little bit longer to find a job. They might be moving between jobs more frequently because they're trying to find the job that they want to do, right? You start out on your first one, doesn't necessarily be the best fit, and so you move on to another one. So we know that unemployment rate is typically higher, but we also know it moves more with the cycle. And so we've seen more of an unwinding there than we have in the main unemployment rate, if you like. So there's lots of different ways that we look at the labour market and assess where we're at. Our overall assessment right now is that, yes, it's coming off the boil a bit. You know, you need two arms, not just a pulse, but we're not back to arms and legs yet. And so we do think that overall the economy is still running a touch stronger than it's able to sustainably supply. Or in economic parlance, aggregate demand, the level of aggregate demand is currently higher than the level of aggregate supply in a long-run sustainable sense. But the gap is definitely closing. What does that look like then in terms of inflation? These are my last few slides. Well, the inflation prints have, again, all been, we think, quite consistent with that. I don't have to tell you guys, if you run through our economic models as economists, if you have got a situation where aggregate demand is running above aggregate supply, you end up with inflation pressure in the system. It comes through. And that's what we're seeing. Some of the pressure that we got, particularly in 2022, was clearly because we had some big supply shocks, nothing to do with demand, really big supply shocks that ran through the global economy. COVID and COVID-related disruptions, the conflict in Ukraine and the impact that had on energy markets in particular, really profound stuff that came through. And you can see that's what you can see in some of the numbers here. Selected goods does include things like those COVID disruptions, and the fuel bar, the utilities bar. You can see normally it doesn't even appear. It's not a big enough move sort of quarter to quarter, but for a period of time, it's one of the major moves in the CPI. But some of what we're seeing, though, we do think is related to demand being high. We've put a lot of stimulus into the economy in recent years, and that's still kicking through. And that's what we're trying to now take out, obviously, with rate hikes. A couple of components of the CPI that we get asked about quite a bit. One is services inflation and the persistence of services inflation. It's a pretty common mantra from central bankers. We're watching services inflation. We're watching for its persistence. We'll talk a little bit about why we're so concerned with services and why don't goods get a bit of attention, because it's about 50-50 in the basket. Well, a couple of reasons. One, especially for a small open economy like Australia, services inflation is much more determined by domestic conditions. With the exception of overseas travel, we produce most of the services we consume at home. Rather obviously, you go get your hair cut. That's a local service. But more than that, most of the banking that we use, our insurers are local, all of those kind of things. So services inflation for us is the best sort of indicator of what's happening locally. It's also the case that it's usually the component of CPI that is more persistent. You don't get big swings in services prices, or put another way, you don't typically go to your hairdresser one month and they charge you $100 for a haircut, and the next month $130, and the following month $110. That's pretty unusual. In fact, if anyone's got that experience, I'd love to know about it. The contrast being something like petrol prices, right? You fill your car up one day and it can be $2 a litre. The next time it can be $2.40. My husband managed to, at the height of the Ukraine conflict and the impact there, managed to find that somewhere charging $2.60. I swear to God, he drove around Sydney looking for that high price just so I'd have a good anecdote. But, it swings around a lot. So my point I'm trying to make is that services inflation generally is steadier, and therefore it is more persistent. It tends to move more slowly. So it's not necessarily a surprise that right now we're seeing persistence. But of course, because we're seeing persistence and it's still above levels that would be consistent with our inflation target, we do need it to come back down. So it's a focus for us because it's a reflection of domestic conditions, and it's a focus right now because it's the component that is holding up our overall inflation rate. So that's why we're getting so worked up about it, as it were. The other part of the inflation basket that we're very focused on, housing inflation, because it's pretty elevated right now, and it's a big chunk of the basket. So between rents, which is obviously what renters pay, and then the cost of doing work on your home or building a new dwelling, which is what owner-occupiers face, both of those are really quite elevated. And I've got housing inflation, rent inflation just here. It's an interesting market for us because we see directly the impact of monetary policy here actually in the very near term is pretty limited. The supply of housing is what it is. It takes time to build new homes, particularly apartment blocks. They take years to get off the ground from when the project gets started. And the demand is really driven primarily by demographics, a little bit by labour market conditions as well, and how much income people have got. And of course, a little bit around preferences too. I gave a speech recently where I pointed out or highlighted that one of the things we've seen recently is that demand for housing has increased because the average number of people living in a home, living in a dwelling, has gone down. I'm not surprised by this, right? And we all went through lockdown where we were told to stay at home, and so people wanted a bit more space. We also now have the shift to work from home for many people. That's a new thing. So perhaps we've got some people who before they would have shared with a couple of other people, had a bedroom each in a 3-bed place. Maybe they're now two of them are in there and they're sharing and using the third bedroom as an office, say. I don't know, but we think that it's things like that going on because that explains how the average household size has come down. So for housing, we've got this challenging combination of those that supply being crimped that I talked about earlier, those cost pressures and not much work getting done, coming together with, yes, strong migration and strong population growth, but also the shift in preferences. And it's just a bit of a nasty cycle. So we're really paying very close attention to housing inflation because it really does matter. And it's a cracking case study for your students on economics in action that they probably in their lived lives can relate to in at least one dimension, maybe multiple dimensions. So to finish up, and I'm conscious of time, where are we with policy? Well, our recommendation to the board at the moment is that the cash rate at 4.35%. We think that it is restricting demand, and that's what we want to do. We still want to get to keep at the moment, have demand growing at a slower pace than supply so that we can close the gap between the two. That's what we think is appropriate, and that's where we think the cash rate is right now. And under those conditions, what we expect to happen is for inflation. I'm showing you underlying inflation here, which is just sort of stripping out all the volatile things like food prices, petrol and things like that, which jump up and down, and we don't have much impact on those as central bank. Looking at underlying inflation, we do think that underlying inflation will continue to gradually ease back towards our 2 to 3% target. But things are changing all the time. We're putting out a new set of forecasts in just a few weeks, actually. So you'll get these slides will go out of date fairly quickly. And we're constantly revising our advice. As I sort of started at the start, it's gloriously grey. It's always changing and evolving. So we're always mindful of what we're missing and how things are playing out in ways that are unexpected for us.